Welcome to the weekly update, where I'll go over the action in the market for the week of January 2nd through the 5th, and then we'll see how things look for the week of January 8th through the 12th. A little bit surprising this past week. A lot of folks were really anticipating the market to continue going up. We ended up having a down week. Now, we've had a pretty good run at the end of 2023. And now we're experiencing some profit taking as we get set to go into 2024. The question that we're asking right now is this just a pullback that we're seeing before we get set to go higher? Or is weakness going to continue to develop and we're going to see more of a significant decline? Right now, the jury's still out on that. When I look at all the daily charts and the analysis that I do there, we're right at some critical points. We thought things were going to get a little bit clearer in Friday's session because we had two big economic reports that came out, but they opposed each other. The employment situation report was stronger than expected, and then the ISM report that came out, that was weaker than expected. So it really didn't clarify any things going forward. We still have this idea that maybe the Fed is done raising interest rates, but we received the minutes this past week saying, okay, yeah, we're willing to go with that. But if the economic reports start coming out are stronger than expected, we may still go back in and look at raising interest rates. So that's keeping the market kind of confused right now, which is what the market likes. When we start to take it for granted that the market is just going to go up, like it's a cash machine that we can just put the money in now and take it out a few weeks later or a month later, and have it naturally be higher than it is now, the market doesn't like that for very long. It was willing to run with that as we ended up 2023. It's not willing to do that anymore. So we're going to go back and evaluate things, and I'll compare that with what we're seeing on the daily charts. We're still looking positive for the most part, but we want to respect the idea that markets can go down just as easily as they can go up and just as easily as they can go sideways. So some notes that I can go through before we get started. I am in the process of rolling out some new shorter videos that just look at 1, 2, 3 charts. Just they're more promotional in nature, just because one of the complaints that I hear that I actually take as a real compliment is that my videos are too long. I like that. I want to weed out the folks that are just looking for short videos. But at the same time, I want to promote both the YouTube channel and the Rumble channel. And sometimes folks are more inclined to watch shorter videos. And I'll talk about things that are actually happening. There may be times when I do a lot of these videos all at once, then I may go a period of time and not do them. So they're not really set on a schedule. It's really the market will dictate what happens here. I'm also getting ready and recording videos and preparing curriculum to roll out the program in 2024. That's an awful lot of work, and I'm pretty much doing all of that by myself. I do have a class on technical analysis, which really goes in depth. I have another class on different strategies that you can implement. I also have another class on the mental analysis, which is probably the most challenging part of becoming successful in the markets, is overcoming your own emotions. And I write all this curriculum myself, so it takes me some time to develop it, to refine it, to record the videos, to edit the videos, to build the website, to make it all available. But I am in the process of doing that. And so just be aware of that as well. Then I do have a PDF that's available in every video that I do post. So you can download what you're looking at right now. You can follow along with the slides. You can look at the charts. Some folks find that helpful. The pivot points are a technical analysis thing that are recalculated every day, and I update those on the community tab on the YouTube channel. I do have a private Facebook group that you're welcome to join. I do have a little bit of back and forth going on there. There's not a lot of people involved in that group. As I start to roll out the program, I'm looking at some different alternatives for those folks that actually get into the courses, that get into the other services that I provide. I want to have a good communication mechanism. I've been trying out Facebook to see if that will work, and I'm not real pleased with that. So I'm looking at some other alternatives. I will be putting up a new poll this week. I'll be going through the results of the latest poll. I haven't actually put the questions up yet as I record this, like I've done the last couple of videos. And then I really take the YouTube comments very serious. If you have a legitimate comment that you want to make, I am more than willing to read it, and if I can, respond to it. If it's garbage, if it doesn't have anything to do with what the video's about, if it's talking about, oh, get onto this Telegram group and this person has helped me have millions of dollars create, it's all garbage stuff. I get rid of that. And then what I did is right at the beginning of the year, there's some comments that just kind of linger, not so much on the daily videos and the weekly videos, but they linger on some of the course videos that I've posted that's now been up there a couple of years. And I like the comments, but a lot of times folks will say something that I really can't respond to. I'm trying not to inflict a lot of personal opinions into what I teach. That's what an instructor should do. The information should speak for itself. And if somebody makes a comment that's obviously an opinion, I may agree with that or I may disagree with that, but I just end up not responding. So what I've done is I've gone through and deleted some of those comments. If you want to contact me, I also give you an email address at the end of each video if you want to keep it a little more private. Also, videos are posted on Rumble. I do have some problems uploading from time to time. Not this past week, but the week before. It took 4 or 5 hours just to be able to upload the video. And I ended up having to try to upload it again. The second time worked and I deleted the first one. Sometimes I'll even run into problems on YouTube. I try to be real systematic with how I post the videos. And if they're suddenly not there, they're late, I'll try to let you know at the beginning of the video if something is happening. But if I haven't let you know anything and the video's not there, it just means that there's some kind of problems with the platform. And here is the link if you want to go over and look at the YouTube, or excuse me, the videos over on Rumble. All right, let's go back and talk about this week's session. For the week, we were down 1.5%, 1.52% to be more precise. This is the first down week that we've had in quite some time, and it also was not necessarily a good start to 2024. There's a thing called the Santa Claus rally, which is the 5 last trading days of the previous year, which for us would be 2023. And then the first 2 trading days of the new year, 2024, we ended up not hitting that. We ended up being down. So that's one of the scores that is looking a little longer term negative. But volume is still below average. Now, a lot of that had to do with the fact that we only had the market open for 4 days this past week. So because of New Year's Day, the market was closed on Monday. You take off 1 trading day, and that's going to drop the average. Our technicals, we're still looking positive. We have been showing some extreme positive readings on the weekly charts. We were very extreme on the daily charts. Now we're starting to work part of that off. We're still now dealing with the intermediate term overbought condition, but how much more weakness is going to have to come in to wear that off? Our trend is still strengthening. The green line is above the red line, so we default to positive, but because we had the down week, the green line is now declining. So for the week, the Dow was down 0.6%, the NASDAQ down 3.2%, the S&P was down 1.5%, and the small caps, which the January effect that the market's really been hoping for, well, that's kind of in doubt. We're wondering, is that even finished now? Is it going to resume at some point? Because the small caps ended up being down 3.7%. Here's some bullet points just to go over in a real high level view here. The stock market had losses after 9 straight weeks of gains. We had a 9-week winning streak. And with the first week of 2024 being down, that streak has now been broken. Mega caps did underperform. A lot of the cause for this was Apple was down 6%. And they're such a huge company and they weigh so heavily on the S&P 500 as well as the NASDAQ and even to the Dow. I believe they're a Dow member. And then there were some downgrades and there's some news coming out that the Department of Justice may be getting close to filing some kind of an antitrust case. So that ended up pushing Apple down, which took a lot of the market down with it. Some of the underperforming areas in 2023, they were actually up on this week or during this week. Interest rates were back up again with the 10-year yield. We had been down under that 4.02% level. Well, interest rates went back up and now we're at 4.04%. And the FOMC meeting minutes, they were released, but they were not as dovish as the market had hoped. They basically came back in and said, we're going to look at economic reports, and if they're stronger than expected, don't take raising rates at some future point off the table at this point, where the market had pretty much thrown that out the window. Economic reports did add to a lot of uncertainty. We're seeing some stronger than expected reports, weaker than expected reports. So we just kind of have to play this game going forward as each report is released. And then geopolitical worries, they can always come in and have an impact on the market. A lot of this right now is happening in the Red Sea. So we're just keeping an eye on those things. This chart is 6 months out of date right now when you follow the gold line, but at least up until that point, when we compare inflation as measured by CPI, it was really matching what we were seeing from 1966 up to 1982. We still could be in this period of lower inflation, but look what happened after that. It really started to spike up, and then we saw hyperinflation going into the mid to late 70s and even into the early 80s. So we don't know if we're still going to be sticking with this or if we're going to deviate from that. This is the RenMac research that I was referring to, where according to what they've found, when we get above 4.04% for the 10-year yield, that's when it starts biting into corporate profits. We were well below that, but in Friday's session, we came back up over that 4.02%, closing at 4.04%. Here are the poll results for a week ago when the poll was posted. Growth in the transports continue to negatively diverge, and I was going to do just a shorter video about that. And it's still happening right now, and I still may end up doing a video. Even as the market was going up, we were seeing this negative divergence. This has gone on since the October lows. For the first week of 2024, do you feel that this will lead to a decline, or will growth in the transport start to improve and justify higher prices? Everybody thought that voted here that growth in the transport divergence will lead to a decline. And right now, it's not really being attributed to that. This is more weakness that we're seeing under the surface. But yeah, that has happened. And then depending on price action in the upcoming week, which is the week we now just finished, if price is positive, do you plan to enter or maintain long positions, or enter or maintain short positions if price action is negative? 88% said, okay, if the market's going up, or I'm plan on establishing new long positions, where 13% said they favor short positions. Then 2024 is an election year, which tends to be positive when the current president is running for re-election. And as of right now, that appears to be what's happening. We don't know if that's going to change. As of now, this is what is likely to occur. Do you feel that 2024 will see the same positive seasonality? 67% said yes, it will. 33% said no, it won't. The markets can continue to be overbought. We're kind of working off that overbought condition now, but it was really overbought as we ended 2023. However, the Santa Claus rally, for the Santa Claus rally to continue, there needs to be positive or at least muted negative days on Tuesday and Wednesday. We had down days. So the Santa Claus rally pretty much got wiped out here. Do you feel that the start of 2024 will see positive seasonality prevail for the Santa Claus rally, or that the negative price action due to the overbought condition will, and I forgot to hit the read more here, will that lead to negative price action? 67% said that positive seasonality will prevail. Well, it didn't turn out that way, where selling from an overbought condition will prevail. 33% said that, and they ended up being correct. Some blog charts, again, I show this every week. This is just the update of earnings and revenue forecasts looking forward. And as long as this is going up, that justifies higher stock prices. Then this one, and it's unfortunate because this is hard to read, and I even tried to use special software to make this little box area be a lot clearer, and I'm just not able to clean this up. But basically it says, when we have 9-week winning streaks like we had, what are the results going forward? and we just had one triggered. That's this blue area. And other times, you kind of have to take my word for it here. Other times we've had these signals, it tends to be quite positive for the market going forward. Then we had the employment situation report come out. The one area that's kind of a concern where we look at all employees and temporary health services, we're dropping below this red line, which typically will happen when we go into a recession. We don't really see a recession on the horizon, depending on one set of charts that we look at. We see that we're going to go into a recession based on another set of charts. And that's where the debate is going back and forth. Right now, this is not necessarily positive in the fact that we may avoid a recession based on this chart. Then we have the ISM, it's contracting. And then we compare that with US non-farm payrolls, where the dark blue line is ISM manufacturing. It's under 50. And that's what it means by contracting. When we get readings under 50, that shows that the economy is actually contracting. When we're above 50, that shows that it's expanding. And we're also still seeing a pretty high reading when it comes to non-farm payrolls. There's a bit of a disconnect between the two. What's going to happen? Is ISM going to come up, or are the payrolls actually going to come down? We did have one FactSet blog post. It was posted on January 5th. It says analysts made larger cuts than average to the earnings per share estimates for the S&P 500 companies for the fourth quarter. This is just a chart representing what they did, where they are we're looking way over here on the right, showing that they are starting to lower their estimates for earnings. Here's another chart that goes kind of hand in hand with that, where we have the fourth quarter 2023 right here. That's the dark blue line, where earnings estimates have been coming down, but the price of the S&P has been going up. So we're seeing a negative divergence here. Is that starting to get more back into line now? Then looking at our charts, this is the intraday chart just from Tuesday, where we had a bit of a positive upward move, but then we ended up closing down. We didn't see much of a change after Tuesday's session, but then on Wednesday, we've been chopping more or less sideways. We had a lower close. Then on Thursday, another lower close, where Wednesday and Thursday were pretty much mirror opposites of each other. Actually, it was Tuesday and Wednesday that looked pretty much the same. Thursday and Friday ended up also looking the same. And then by the time we got finished, we were down on the week. So just looking at the 4 trading days for the first week of 2024, all of the different indexes were down, with the small caps being down the most. They were really rip-roaring as we were finishing out December. Now we're seeing some profit taking, followed by the mid caps. Then when we go back to the beginning of 2023, because I don't have a lot of data, this previous chart, this is the year-to-date chart too, because it's the first week of the year. So I kind of wanted to include this extra chart showing how have things performed since the beginning of 2023, where all of the indexes are still up. And then going back to the all-time high, we have the Dow and the NASDAQ 100 that were up. We have the S&P, which has slipped a little bit more negative, and all of the other indexes are negative since the all-time high. And that all-time high is based on the S&P 500. Looking at our sectors, some of the areas that had been weaker in 2023, they did better, like healthcare, utilities, and energy. And Staples was down just a little bit. And again, this is just the 4 trading days, where some of the stronger areas, tech and consumer discretionary, they ended up being down the most. And these were the stronger areas in 2023. Here's our relative rotation graph, where we're just seeing energy just fly right over here to the weaker part of the chart. We're seeing the financials, which are still hanging in there and doing quite well. We also have tech that's been hanging in there. We're seeing a little bit of weakness when we look at healthcare. And then some of the other areas like real estate, utilities, Staples, some of these are showing some improvement. So they're blue, but they're not really breaking up into the stronger areas yet. Then looking at the sectors for the 4 trading days, where we had utilities, healthcare, financials, and energy were up, followed by communication. And then the rest of the S&P sectors ended up being down. This is again going back to the beginning of 2023, where we have communication, tech, and discretionary doing the best. All of the other sectors are still negative. This goes back to the all-time high, where energy's been under a lot of pressure, but it's still been performing the best, followed by tech, industrials, and healthcare being positive. The other sectors are still negative. Keeping an eye on sentiment, we're currently coming in at 74. That's one tick under the extreme positive, or what they have here, extreme greed reading. And after getting up close to that 80 level, we are starting to come down. When we get above 75, that means that folks are partying on just a little too much. And we start to look at leaving the party, since we use this as a contrarian indicator. So we're seeing this coming down slightly. Here are the active asset managers, which had been extreme positive. When they get really high like this, we use it as a contrarian indicator. Well, with the week that we just saw combined with the previous week, we're seeing them not be as bullish as they were before. So the latest reading came in at 70.95. We're looking at the VIX, where as we've been under pressure a bit, we're seeing the line chart as well as the bar chart continue to go up. But they're still coming off of very low readings, showing there's not a lot of fear. The Ulcer Index was pretty much flat. We're seeing it start to turn up on the daily chart, where it really hasn't shown over yet into the weekly chart. The Ridex Bear Bull ratio, folks were getting a little too optimistic. Now we're seeing some weakness, so we would expect this to start to go up. Please note that there's a one-day lag with this chart. This is for Thursday's close. We won't get Friday's close until Monday's session. And then the latest reading of the American Association of Individual Investors, they had been kind of extreme positive, and then they started to drop back down. This is also, it's still looking strong longer term when we compare cash to the tech sector, where the black line is still going down. That's actually positive. I know it's counterintuitive. We did see a little bit of a turn up with the downward move that we saw this past week. Keeping an eye on the GDP Now forecast going forward, they're actually turning back up a little bit. We're looking at about 2.5% with the latest reading. When we look at the top and bottom forecast, we're looking at about 1 3/4 to the upside to about 0.5% to the downside. The takeaway from this is GDP projections going forward are still positive. If we were looking to go into a recession, these would be dropping more negative. And this is what it looks like on the bar chart, where everything is still maintaining at least some kind of positive growth. Looking at the spread between risky and not as risky options when it comes to bonds, if this did come up just a little bit with the down week that we saw, but we're still declining overall, we get concerned when this goes up. The latest reading of the National Financial Conditions Index still shows this declining. We get nervous when we go above the black line. Also, we haven't seen an update since the beginning of November with the domestic tightening standards from banks, and that is still showing a bit of a pullback there. We did get an updated real-time SOM rural recession indicator, where it actually turned down a little bit, and we're still below this red line. We get nervous when we go above the red line. And we saw a little bit of a tick up here with our smoothed recession probabilities, but it's still well below the red line. And then the Brave Butters hasn't been updated since the end of December, where it's actually coming down a little bit after it had been going back up. Keeping an eye on inflation, starting with the new quarter, we don't have a very populated chart here. This measures CPI inflation, core CPI inflation, PCE inflation, and core PCE inflation. And we're going to be getting CPI coming up in the upcoming week. Keeping an eye on the Fed, there's still a 93.8% chance that at their next meeting on January 31st, they will leave rates unchanged where they're at right now at 5.25 to 5.5. And we're seeing that getting locked in just a little bit more. The dark blue area is where we're at now, a day ago, a week ago, and a month ago. Now, looking out into the March meeting, and this is what the market had been anticipating as the first possible time that the Fed may cut rates. Right now, it's dropped from the previous reading. We're getting a 62.3% chance that they'll drop rates 0.25%. There's actually a 33.8% chance that they're going to keep rates the same. Now, if the economic reports that are coming out are stronger than expected, we're probably going to see this right area start to go up and the middle area start to come down. And this looks how it changed just recently, where the dark blue area is where we're at right now, then a day ago, a week ago, and see how this was a lot higher and it's starting to come back down a little bit. So they're starting to gravitate a little bit more over to this idea that the Fed may not cut interest rates in March. Then looking at the Fed balance sheet, it does continue to contract the way the Fed said it would. Here's the year-over-year change. It's also going down. Keeping an eye on breadth, we turned down just a little bit based on price and volume, but we're still looking positive longer term. With our new highs, new lows steady, we're pretty much flat with the 4-week moving average. We're starting to decline with the 10-week moving average. And it's not so much that we're seeing an expansion of new lows. We're actually just seeing a contraction of new highs. The advanced decline ratio is still above 0, so that's positive. Accumulation distribution is starting to roll over a bit, but it's still above the advancing moving average. And this is a smart money indicator, and it's still looking positive. Keeping an eye on our trend, we are in a trending environment. The ADX is above the moving average, and it's above 20. The green line is on top. Even though it's declining, we still default to positive. Our Arun indicator is still looking a little more positive. It actually increased this past week or went more positive. We're above 0 when we look at the oscillator. That's because the green line is on top, even though it's declining. But the red line, which are sellers, that is also declining. The mass index is not generating a signal. Here's the daily chart where it looked like, okay, we're just off to the moon. We never made it back to the intraday high for the S&P 500. We did set all-time highs with the Dow and the NASDAQ 100. We never did that with the S&P 500. And now we're coming back down to this pivot point. We actually lost that after Thursday, but with the slight update, we were able to get right back up to this level in Friday's session. And you can see where volume is still continuing to be below average. The trend channel, we're still on the upper side of this trend channel going back to 2009. That's still positive. And we're breaking above this high that we set in July of 2023. We broke above that, but now we're starting to come back down. If we still see this falling, will this end up providing support? But on a trending basis, we're still looking positive. We have a red moving average going up. Price is still above the moving average, even though it did decline this past week. We're still looking strong with our long-term trend for the S&P. We're showing a little bit more weakness here with the McClellan oscillator, and we're seeing this on the daily charts too. We're dropping below 0. And anytime that drops below 0, that's more short to intermediate term negative. We're still getting a very high reading based on price when we look at the summation index, but it is starting to come down. We're also starting to come down with the summation index after giving an extreme positive reading. Looking at the Swenlin trading oscillator, we did decline and drop below 0 based on price and volume. That's more negative. And with the bullish percent index, we're seeing pretty much this same chart. We were holding up fairly well, but now we're starting to show some weakness. When this turns into a negative signal is when we drop below 70, and we haven't done that yet. Looking at our momentum, we're still positive with the PMO. We're coming down a little bit based on price and volume after giving extreme positive readings. With our PMO studies, we are seeing a bit of a negative divergence, and we were seeing these on the daily charts too. The S&P was going up, but the PMOs that are rising was going down. We were also seeing a negative divergence with the buy signals, and we're still extreme positive with the PMOs that are above 0. The Bollinger Bands, after giving us an extreme positive reading in December, is now dropping back down. When we look at our oscillators, we're still looking okay with the slope and KST. Those are shorter term. Then we have our intermediate term oscillators, the MACD, the PMO, and the PPO. They're still looking good. The TRIX and KST are also positive, but we're getting to some extreme readings, like with the slope and with our longer term oscillators. So we want to keep an eye on this one. The chicken money flow is continuing to look positive and is looking better, where it's still positive on the daily chart, but now it's declining. The chicken oscillator has actually turned negative on the daily chart. It's now starting to come down after giving us an extreme positive reading. The force index is declining, but it's still positive. Where on the daily chart, it's actually turned negative. We're still coming down with the money flow index after giving an extreme high reading, but we haven't crossed below this 80 point yet. Since we had a down week, we ended up being down below the midpoint with the rate of change. We are coming down just a little bit with our 50-week rate of change chart. The RSI based on 14 periods is still positive, even though it declined. We're still above 50. The weekly special K chart is trying to turn back up, but it's still well below this moving average. And we continue to be positive on the daily chart. The Stochc RSI is coming down after being extreme positive. The Williams percent are also declining after being extreme positive. We're now dropping below this extreme positive reading with the ultimate oscillator. We're turning more negative on the daily charts. The vortex, which is also crossed over negative on the daily charts, here we still show the green line above the red line. The Copic curve continues to be positive. And we're still not running into really any longer term support levels based on this chart, because even though we had a down week, it wasn't a monster down week. Our different charts, we're still looking okay with the Heiken Ashi. The very last bar that we see here is a little bit concerning. That's what we call a doji when we open and close at the same spot. Now, that could be positive because we had a down week. This is usually negative when this happens after a nice run up. The Kegi chart continues to be positive, even though the black line is now pointing down. We've turned negative on the daily chart. The Renko continues to be positive both on the daily and weekly charts. The 3-line break showing a little bit of weakness on the daily chart, where we're still positive on the weekly chart. Then our ease of movement, we've turned negative on the daily chart, where we're still looking okay with our 14-week study here. And we didn't have any new X's or O's drawn with the point and figure chart. We didn't see enough price movement for that. We're still working off of a double top breakout that was generated on the 20th of November. And we're switching from being positive for quite a while with the Elder's Impulse system on the S&P. Now we're switching over to neutral. And we continue to be positive with the parabolic SAR on the weekly chart. We switched over now to negative on the daily chart. The PPO studies, we're still looking good with the long term. We're turning down a little bit in the intermediate term. We're declining, but still barely positive in the short term. And then here's some daily charts that I pointed out. The negative divergence that we're seeing between growth and value is a big concern. At least that's what I'm seeing here. And we're seeing that across the board. We're also seeing that in the small caps. The other area of concern is the negative divergence between the Dow and the transports, where with the S&P growth to value ratio here has really been declining. And the mid caps have been holding up better, but now we're starting to see some weakness here. And this is an even bigger concern. Even as we were going up with the S&P, we were going down with this ratio. Another couple of days, and we're probably going to generate a death cross here. And that's longer term negative. We did start a new cycle on January 2nd, and so far that cycle appears to be down. And here's the negative divergence that we're seeing with the Dow theory, traditional Dow theory, where even though we were down, we're still holding up okay with the Dow, where with the transports, we never even got back to this previous high, and we've actually been declining. That is not suggesting real strength in the market. We did see a little bit of a tick up overall as interest rates were going up this past week for the utilities. The broad market, we're now looking at 2024, so we're focused over here on the right-hand side. And we tend to be up 20% of the time with a return of minus 0.4. That's figuring this year into the calculation. Then when we look at a plain vanilla chart of the S&P, the mid caps and the small caps, we are rolling over with the S&P, showing a little bit more weakness with the mid caps as well as the small caps. But the Dow continues to be in a good solid uptrend. The NASDAQ is also in an uptrend, even though it pulled back this week. The NASDAQ 100 also pulled back, but still in an uptrend. Here's a weekly chart of the QQQs, where it seemed like every day there for a while we were setting a new all-time high. Now we ended up having a down week. The mid caps showing now a golden cross on the weekly chart here, even though it was down on the week. The small caps also getting really close to a golden cross here, but they're starting to come down too, at least in the last week. The NYSE is looking more positive, even though it was down on the week. All stocks fell back, but are still in a longer-term uptrend. Sorry, I had to clear my throat there. We have been seeing some improvement with the 30 biggest software companies in the U.S., but they just got hammered this past week. The FANG index is still hanging in there, both on the daily chart and the weekly chart. ARC ended up having a down week, but it's still in a longer-term uptrend. Looking at the banks, the financial sector is actually showing some improvement. But on the weekly chart, we're getting extreme with the RSI. The price pattern is looking quite positive. And on a momentum basis, we're also looking positive with the bank index. And we're still seeing more money going out of all commercial banks rather than money going in. Here's just a plain vanilla look at Dow theory. Now, traditional Dow theory just looks at the Dow and the transports. I also include the utilities, where we've been breaking out with the Dow, and we've been really under a lot of pressure on a comparative basis with the transports. We have been seeing some improvement with the utilities. Some broad market measures, we are looking a little bit weaker with the CRB index, and this measures commodities. Another week or two, and we could see a death cross here. Oil still chopping around the 70s. We closed at 73.81. Copper, which again, take your pick. If we're looking better for copper, that tends to mean economic strength. If we're looking weaker, that tends to look at economic weakness. And now, for at least this past week, we've been chopping more or less sideways. We're still in a longer-term uptrend. The dollar, after seeing some weakness, did bounce back up this past week, and that also pressured stocks. Gold is still continuing to be in an overall uptrend, but it's really not breaking out yet. Silver is getting close to seeing a golden cross here, but it's been really chopping sideways. Keeping an eye on bonds and interest rates, we are seeing an improvement with the total bond ETF. Even though bond prices were down, we're getting close to a golden cross here. And the stock to bond monthly chart, looking at the ratio, it did turn up just a little bit as stocks continue to outperform bonds. And then this is one of these anomalies that we've been watching for quite some time. This is the 1 month yield, and we subtract the 3 month yield. We should always get a negative result because the further out yield should be paying more. But for the last month or so, we've actually been getting a positive result for this. Looking at interest rates on a daily chart where they had really been declining over this past week, now they're starting to go back up. There's a weekly chart showing how we're turning up with the US, UK, and German rates. We're still tending to decline with the Japanese rates. And then this is a chart that I have been talking about in the daily video. Now I'm just going to keep showing it in the weekly video. This just measures the times going back to the early 80s when we spiked out with the 10-year yield and then started to come down. You can see all these different negative things that happened. We don't know at this point. We don't know two things. Number one, is there an event that's getting ready to brew that last November when we were hitting 5% with the 10-year yield, is that going to come out at some point in the future? And then secondly, there have been other times when we've seen spikes here and it didn't necessarily lead to some kind of an economic bad scenario. Looking at some relative studies, we start by looking at the intermarket analysis chart. Since we've only been going for 1 week, I'm going back to the beginning of 2023, where stocks are doing the best, followed by gold, and then the dollar, and then the price of bonds, where oil is showing a bit of improvement, but is still negative. This is going back to the all-time high, showing that energy's in the lead, followed by the dollar, gold, and stocks are looking better, but bond prices are now starting to show some more weakness. When we look at a ratio between the NASDAQ 100 and the S&P, yeah, it came down a little bit, but it's still in a pretty solid uptrend. The S&P 100 to S&P 500 ratio, it actually turned back up. This has been an area of concern where the S&P 100 has been underperforming the S&P 500, but it is showing some improvement, even though longer term we're still in an uptrend. The growth to value ratio, this is another area of concern. In a good solid environment, we want to see this ratio going up. We've now seen for the last few months this ratio actually going down, even though it's still in a longer term uptrend. The gold to S&P 500 ratio is still showing gold underperforming. And then gold to the dollar, it came down a little bit after coming up to this long-term trend line because gold ended up being down while the dollar saw a bounce this past week. Bonds are still underperforming stocks when we look at this other measurement. And low volatility stocks, they did see a bit of a bounce with the weakness that we saw this past week. Discretionary is still outperforming staples, even though it pulled back in the last week. And energy is still underperforming the tech sector, even though energy did bounce in the comparison. Some longer term charts, the NYSE breadth thrust, we're still working off of that signal from October of 2022, so over a year ago now. and that is on the books indefinitely. So that's a longer term positive setup and seasonality that's still in the background. And then we did have two ZWAG NYSE breadth thrusts generated within a 12-month period, actually less than 12 months. But to see one of these is rare. To see two of them so close to each other is even more rare. And that's also indefinitely on the books. The Zohorchak method hasn't changed. We had come all the way down to -6, and we were showing some improvement back up to 0. So right now we're back up to the neutral point. And then this is a long-term chart going back to the 1987 crash with the S&P. We're right about on the trend line now. We're still just a little bit above it. Here's a shorter term look at that same chart, just taking a smaller time frame where we're still above this. But keep in mind, as I warn in my daily videos, I draw the lines on here. They're not generated by a computer. I just kind of have to eyeball this. So don't necessarily take them as gospel. And at the same time, the thickness of the line too can sometimes bleed over into what we're seeing in the chart. Where we're turning down just a little bit with the weekly chart of the NASDAQ 100, we're coming back down below this longer term trend line. The NASDAQ 100 to Dow ratio still chopping along and not giving us an extreme reading. We look at the Qs, the small caps, where it did tick up just a little bit. We did get a really high reading and we were starting to come down, but now we ticked back up over the past week. We are still seeing some improvement with the cumulative new highs, new lows for the NASDAQ. This longer term measure is still starting to turn up. However, when we measure the new highs minus the new lows on the bottom, after being positive for quite some time, we're now starting to drop negative. We're keeping an eye on the 3-month yield. It looked like it possibly has topped out and was starting to come back down. That's what happened back in 2007. We're wondering if that's going to give us a warning sign if the 3-month yield continues to fall. So what's our outlook? And this is just for Monday's session. We're wondering, is the January effect over? Is it going to come back, kick into gear, and show some improvement? We don't know that at this point. There's some seasonal historical studies that could suggest, okay, this is just a pullback before we get set to go higher. But at the same time, we have to respect what price is actually doing. Our technicals are still positive on the daily charts, but they're starting to really show some weakness. And we're right at the 20-period moving average. And that's both the simple and exponential moving average. The hope was that after Friday's session, or during Friday's session, we would get the employment situation report, and then the ISM would be coming out, and they would be friendly to the market, and we would break back above the 20-period moving average. We were not able to do that, even though we had an up day on Friday. We will get consumer credit on Monday, and then we're keeping an eye on all the different geopolitical events. Right now, we're kind of focusing more on what's happening in the Red Sea. Then here's the economic calendar for the upcoming week. The important ones are we're going to get CPI on Thursday and PPI on Friday. Seasonality, and I did change this over to January. We won't know the results of January until the end of the month. So for right now, we're just looking at January 8th, which will be Monday's session, where we tend to be negative with the Dow, quite negative. We're neutral to negative with the S&P, and we're flat out positive with the NASDAQ. We will be on the 5th trading day of the month, where we do see a little bit of weakness during a pre-election year for the S&P 500. This is the January effect, which we think started. It was really cooking there for a while, but has it ended? Is it just pulling back before it's getting set to go higher? We don't know that yet. And then this chart I'm just going to be showing in the weekly video. There was a price pattern in 1982 that seemed to match up with what was happening in the latter part of 2023. And so we're wondering, is price going to continue what we saw back in 1982? We don't know if that's going to happen or not. This is just something that we can use as a guide. Then when we look at election years and seasonality, when we have a presidential election year, that's the dark blue area, and we tend to start off pretty choppy. So that's not necessarily a surprise based on what we've been seeing. Also looking at this chart, we look at the green dashed line. It also tends to start out the election year choppy. But when we look at the sitting president running for re-election, we tend to see more positive seasonality. But at least up to this point, we haven't seen that. And then looking at the different days of the week in 2023, where Monday tends to be the most positive day, followed by Friday, and then Thursday is also positive, where Tuesday and Wednesday tend to be negative. And then going back to 1950 for the S&P 500 during an election year, we're up and down split. It's 50-50 as far as that's concerned. So our scenarios, we're not really going with the down one right now. We are seeing weakness develop, but our charts are still positive overall. It's hard to go with the up one, but we would still default to that because our charts are still mainly positive. But that's why I only buy into strength and I sell into weakness. And we're also concerned about our ADX because the short term is now dropping below 40. The intermediate term is still above 40. That's an extreme reading, even though on both charts, the ADX is dropping below the moving average, suggesting that there's a weakening trend. Doesn't necessarily mean it's a change in trend. It just means that the trend that had been in place is starting to show weakness. The warning signs, we're really, at least I'm concerned about this growth. It just has not been keeping up. The risk on posture, it was looking a lot better, but now the last few days it's been going down, even though it was up in Friday's session. And then the transports continue to negatively diverge from the Dow. The equity put call ratio based on 5 periods, it ticked up slightly, but it is now going back up. The vortex has crossed over negative. Our 1 to 3 month short-term bond spread continues to be positive, where it should be negative. The parabolic SAR chart did switch over to negative. The Copic curve is also negative. Our oscillators are starting to roll over, and they're still extreme, but they're dropping below their moving averages. The PPO, which is a momentum oscillator that we look at for the NASDAQ 100, is negative. It's below its moving average. Some long-term signs. We're still dealing with those long-term weekly trend lines there, and we haven't really decisively broken above or broken below them. For right now, we want to respect those, suggesting that they may be signaling a top. The cumulative new highs, new lows for the NASDAQ are weaker, but they are showing some improvement. The 3-month yield that we're keeping an eye on, that it was up a little bit, but overall it has been declining. We're wondering if that's giving us a warning sign. And then earnings season, as the earnings are released. Our daily special K chart is positive. Our long-term equity put call ratio chart, that's positive because it's going down. The bullish percent index for the S&P, it's coming down, but it's still extreme positive. The Zohorchak method has switched from being negative over to neutral. And we did recently generate golden crosses with the Russell index, the small caps and the mid caps. Small and mid cap growth, they continue to be positive, but they're really chopping sideways. I did show you both of those charts. The financial sector is showing lots of improvement and is positive. And then our 50-period new high, new low steady for the S&P continues to be positive. Then longer term, we did see 2 ZWAG NYSE breadth thrusts generated within the last 12 months. Seasonally and historically, January tends to be positive when the current president is running for re-election. We're waiting to see if that's going to actually happen. Long-term positive seasonality and setups do remain. And I will mention one that's not on here. There's also another measurement, which will be the first 5 trading days of January. What the Stock Traders Almanac does is they look at the Santa Claus rally, and if that was up, it gets a +1. If the first 5 trading days are positive, then that would get a +2. And then at the end of January, if January was up, that gives us a +3. That's called a trifecta. Well, right now we're 0 for 1. And unless we have a really strong up day on Monday, we're going to be 0 for 2. And that does not necessarily bode well for the year. Our conclusion, we are positive, but weakness is developing overall. In the short term, we're still dealing with those 20-period moving averages. Intermediate term, we are seeing more weakness, but we're still positive in the long term on our daily charts. Thank you. I hope you found this helpful. I will be preparing the intermarket analysis video over the weekend, as well as the deep dive video. I hope you have a really, really good weekend, and I will talk to you in the next video.